Live from Westchester County and Mexico, it's David Balin and Stephen Whiting talking about this week's The Point. And our title this week is When Uncertainty is Policy, because I can guarantee you that the one thing we are certain about is continued uncertainty of policy. Let's review some of the events of the week. Stephen, we saw that the Supreme Court ruled 6-3 against the Trump administration on his imposition of tariffs last year. I know you have lots of comments about that. There's going to be an interesting response, which we'll also talk about, which is the reimposition of tariffs. And as you told me, Trump was not particularly friendly to those Supreme Court justices at his State of the Union. Now, what does that all mean? We'll talk about that today. There are deep impacts of tariffs on the economy, and we'll talk specifically about what those look like and their implications. There was certainly a very strong response from the European Parliament, who basically said that our tariff policy was chaotic, and that's hard to disagree with. And then we'll discuss a little bit about AI and specifically about NVIDIA's report. But we are going to begin with an impact associated with the actions by the U.S. in negotiations and in military preparation for a potential attack on Iran in the event that those negotiations are not concluded favorably. Now, all of this is a backdrop of incredible drama for markets due to uncertainties. And Stephen, if we go to the next slide, I think it would be great if you could introduce a little bit about what's actually going on, these three narratives that are happening at the same time, and what your assessment is of their macroeconomic impact, both presently and over the course of 2026.
Thank you, David. So one of the things to think about here is we haven't talked to you in detail about tariffs since last year. The initial shock that we would be imposing tariffs that looked like the same level of the Great Depression dropped markets 20% in early April of last year. Subsequently, the actual tariff collections were more than 60% below what the headlines at the time implied. Similarly, we're not going to get relief from tariffs. The president talks about trillions and trillions. The incremental increase in tariffs was $185 billion last year. But the uncertainty about tariff policy still forced down 108,000 job losses in the U.S. manufacturing sector was not what was planned. So we're going to talk about trade again, just to bring you up to speed. We don't think it will be the most important thing going on in markets. What's going on inside the technology sector now, the fears that the boom is unsustainable, the facts that the spending growth rate, what we saw out of NVIDIA with a 73% revenue growth rate and upward guide to the coming quarter, the spending plans of these companies, and then the abject fear that they're not going to use software to run AI. That's very important in markets, and that's point three. But we'll also go over the fact that now the strongest sector in the equity market this year is the energy sector. The crude oil price is only $70, but it's risen 15% this year because of another issue of policy, the potential for the U.S. to strike Iran. Not that it is terribly important to crude oil markets itself, but it sits right next to the most important artery in the world, the Straits of Hormuz, where more than 20% of global exports traverse.
And what all of this means, right, is that you have a high degree of uncertainty, but as we sort of sift through it, there are some underlying themes that are very important about what will happen to U.S. employment, U.S. growth this year, and ultimately the world economy. Let's go to the next slide if we can. So we want to talk about this concept of trade uncertainty. When you look at this uncertainty, what we're talking about is the ability for companies to plan and the actual prices of imports associated with those things that manufacturers use or that are resold in the United States. So if you go back just a year ago, right, when the initial tariffs were imposed, we had a 20% fall in the markets, and then we had a recovery. And I want to remind you that 20% is relevant also to the discussion of what happened in software recently. But the truth is, Stephen, it did have an impact, right, on the psychology of manufacturers and on the hiring of individuals and on the basic ability to plan. And that is really what you were talking about yesterday when we talked about this current, reimposition of tariffs by Trump.
So we're going to talk about that in some details. Again, the president will use a different authority, the Trade Act of 1974, to impose 10 or 15% tariffs. So the collections probably won't drop, but he has 150 days. And then there needs to be some act on the part of Congress, or they'll shift to some other authority. But the main point here on this chart on the right was that we actually collected the equivalent of 6% of the cost of merchandise import tariffs. Those charts that were based on holding up a plaque of, hey, what other countries charge us in April of last year implied something closer to 30%. So the view was that it would be the largest tax increase in history. It wasn't, but that tariff uncertainty still had very significant effects. And part of the problem here, we can go through this on the next page. If you think about how tariffs are supposed to work, I mean, we have taxation with representation. Congress is supposed to give us some representation to tell us in a predictable way what Americans will pay for taxes. But you can take a look. President Trump suggested 25% tariffs on Canada, even though we have a free trade agreement. Used the threat of tariffs, 10% first, escalating to 25% if Denmark didn't give up Greenland or NATO didn't agree to do this. Tariffs on Brazil because of the treatment of their former president. So again, this was all going to be ad hoc. And the Supreme Court said you can't use the International Emergency Economic Powers Act for your own personal negotiating power. Now, if you go to the next page, more to the economic impact. We lost 108,000 jobs in the manufacturing sector last year, even with so-called tariff protections. So that was not what was intended. When we read the ISM report, the Institute for Supply Management, been around for a century, 8 or 9 out of 10 industries, domestic manufacturing industries, complained every month that their imported goods costs that they used to make higher valued output was going up, and that either tariff retaliation or uncertainty of their supply chain was hampering domestic manufacturing. So these are facts. You can take a look at the ISM index, contracted last year, and it didn't need to. Overall GDP growth was over 2%. We didn't need a manufacturing contraction over trade uncertainty. Inflation. Now, you heard the State of the Union, how far oil is down. We're going to talk a lot about oil. It was down 17% last year, but the CPI still rose in above target 2.7%. So these are all evidence that there was trouble here with tariffs.
That's correct. And if you take a look at both the comments of Lowe's and Home Depot, right, they've said that, there is, concern about the cost of goods, right, and the willingness of people to make commitments, households to make commitments to do renovations, right, and restorations of their homes. These uncertainties and the fact that inflation of those goods, for example, that they're selling is well above, right, 3%, is the issue, right? These uncertainties are combining with a negative employment impact to cause people to feel less confident. We see that in the consumer confidence data, again, through a sort of cycle, a downward cycle that's unnecessary, to your point, given the underlying potential strength of the economy. Next slide.
So the left picture.
Let's just talk about this, Stephen. So
Yeah.
you would expect, right, if you take a look at the chart on the left, that from where we are today, right, you'd expect employment to rise, right, given that
Right.
chart, right? And so if that's the case, you have that, right, which would be presumably a tailwind, but you have all of this concern about like AI's impact as a headwind.
So yeah, this is the interesting story. That right picture shows, the roughly 500,000 jobs that are in IT services that are easily replicated. Data entry jobs being, one that we've lost for a long time, but software infrastructure businesses, these sorts of things, you can see that peak there in an industry that's grown a lot, but it's a very small industry. When you take a look at the left picture, what it is the measure of the breadth of private sector industries that are growing employment. Now, we mentioned manufacturing lost 108,000 jobs last year. That's not where the bulk of the employment is. It's going to be marketing, sales, finance positions, advertising. All of these things move up and down in a cycle, as the economy is a business cycle, and the more cyclical parts of it. Healthcare goes steadily up. We understand, that the aging of the population. So last year, 54% of private industries contracted employment. Some of this was trade policy uncertainty. There were other concerns about prices, inflation, a whole variety of things, the lagged impact of monetary tightening, all of these things could allow the weak sectors like construction to add to employment in the coming year. We were poised again for a stronger breadth of growth in the economy, but what we don't need again is more policy uncertainty to stand in the way of what should be an improving breadth of employment. Now, especially that we have the challenge of AI, which is beneath the surface, slowing down the demand for labor.
Good question. So let's go to the next slide. So right now, the odds, right, if you look at poly markets of a strike on Iran are about 70%. And what's going on in markets, of course, is that we see that the price of oil is up a little more than 15%, right? And you can see the performance, of course, of the energy sector. And all of this makes sense because if there's a breakout in these shares, it's indicative of increased profitability. That actually may be a very unsustainable trend. And you can see on the right-hand side what the sector performances are, right, which have materials and energy as the leading sectors. On the negative side, you can take a look at where there's trouble spots, and that's in the IT sector. No surprise, we've talked about that, but also in financials, which have taken a hit recently associated with private credit concerns in the alternative investment managers, but also a ripple effect onto banks, which are perceived to be somewhat more at risk for making loans in a more lenient way in an environment that seems to be turning. And those loans have been, in about 25% of them, to software and software-related businesses. So you can see how the news is directly impacting markets, Stephen, in a very short-term way, which of course is not how we invest, but is in fact what's happening at the beginning of 2026.
Probably because we have no more on this, and we saved some of it from last week. Just to say, like, why is it important that this energy spike is actually having an effect? Well, oil's half the level it was in 2008. There's record high American oil and gas production. There's healthy levels of inventories, and OPEC has increased its output 6.5% over the past year, reversing the cuts of the last couple of years. So the oil price is poised probably to go down. But here's the thing. The Straits of Hormuz, right off the coast of Iran, it's where more than 20% of global exports traverse this tiny area. Iran shut it down for a few hours during war games. And the potential, again, for a conflict to interrupt global oil trade is there. It wouldn't last long, but the consequences, the price spike, would be very severe. For every 1% drop in oil production, the price of the commodity tends to move up 15% over the short run. So it's not impossible to see $100 oil for a brief period of time.
All right, let's go to the next slide. So there have been incredible articles claiming, that just a year and a half from now, we're going to see AI, destroying white collar employment. Ultimately, initially, by the way, with an increase in profitability, Stephen, which I think is actually highly likely to occur. But what is absolutely clear is that over the course of the last 4 years, and as estimated through 2030, we're seeing a $3 trillion expenditure in the development of data centers, right, that are going to be using right now about 5 principal LLM models here, and that doesn't include the ones that are being used overseas. So what this capacity does, what the energy is actually being built for, is this constant running of AI by individuals, by companies, obviously, but to your point, Stephen, by software itself to actually deliver, right, its benefits. And the issue,
That's
right,
right.
if you think about it, go ahead, please.
When I interact with AI, I get Excel spreadsheets given to me. So the
Exactly.
AI agent is using Excel. Now, we're going to have like debates over these things. And if we take a look at the next page, you can see how the market is shaking out in terms of these differences. That left picture shows electronic components, and this is hardware, 100% return. Memory chips going through the roof. Semiconductors already had the great big rally, but we're still up another 16% this year. If you take a look at sales management software, HR services, they're collapsing. So there's great dispersion. the tech business has parts of it that are going up. They're normally reasonably correlated. They're shooting up in value, others that are shooting down. Within software, it's almost as if, hey, we don't care if you have a cloud business, we don't care if you have a cybersecurity business, we'll just treat you like your HR software.
Right.
So those are the really strange things going on.
And this is exactly the same as we've talked about in our active asset allocation, Stephen, about this idea that when you see a disruption that is completely, non-discriminate, right, doesn't discriminate between winners and losers, right? You have an opportunity in that sector, unless literally the world's coming to an end. So we do expect a rebound, right, in software in general. We do expect, right, that there are going to be very significant winners and losers over the next several years in this area. But there are a few things we should just point out, right? The demand for chips is not ever up. The demand for energy centers is not ever up. When the build out took place, right, with the internet and telecom, at some point there is overcapacity, and that could occur in data centers and in energy, and ultimately that would have an impact on the number of chips that are in demand at that time. Within software,
David, before we move,
you're sorry.
no, before we move on the slides, just maybe one other point about software and market disruptions. It's kind of overlapping that tariff collapse of April last year, but DeepSeek, the Chinese inference model that was able to produce large language model results with less computing power, created a great scare beginning in January of last year. And NVIDIA's semiconductors all had a temporary bear market. During that period, software also fell. Took a little while, but it fell 26%. So within 2 months later, partly then in the general rebound of the market, though, it was up 35%. So we've seen this before, these disruptions. There are times like 2000 to 2002, 2008 that are different. But the potential for just fear to drive down these shares in a generalized way, we've seen it as recently as last year.
Right. And just, I want to make these points, which is that this whole idea that the market is correct about this and misses what you said earlier, which is those software companies that embed AI effectively and then deliver comprehensive tools to individuals that include the AI are very important as part of our economy, because not everyone is individually going to use, and every small company is going to individually use AI by itself to replicate that software. The number of companies that do that effectively might be many fewer, right? And Microsoft is a prime example of this, right? We've talked about the fact that they run the cloud, right? They actually provide, the infrastructure, if you will, for many companies, and people aren't just going to turn that off. In fact, Microsoft is embedding an enormous amount of AI in all of its components of its business. So the idea that it's somehow going to become less profitable, that it's going to become less necessary, strikes us as very odd. And you mentioned this about cybersecurity software, and it was very interesting that I think it was this week that a lot of the AI tools in America were used to set out an attack on Mexican infrastructure and in Mexico financial service companies, right? And these, need to be protected. And so the point is there are certain beneficiaries to the type of change that are going to happen with AI, and there are certain employment impacts that are going to be negative. The initial actual benefit of AI will be increased profitability. And that is something that was talked about and kind of dismissed as a result of these scare tactics and scaremongering. And Stephen, I just want to have you discuss something that we talked about personally, which is, we've seen other disruptions, like it was like when telephone operators lost their jobs, right? Executive assistants are going to lose their jobs. Some software engineers are going to lose their jobs. The question, though, of the resilience of the economy is, in fact, what everyone is claiming is they're gone forever and there are no replacements. That's kind of where
it's all a matter of time. You just made some that I think people might remember, but we also have to remember, that we're operating with something like 95% fewer farm workers than we used to have, a century ago, because automation has replaced farming. But people went on to do other things. And how rapidly it happens matters. If you were to have some sort of economic shock, like 08, 09, layered on top of technological job displacement, then you've got a big problem. I think that the one thing that maybe people don't think about it big enough, because they think we can't do it again, is that we can have some sort of big macro stimulus again. I think that is possible, that there would be lots and lots of market interference, macro policies, fiscal spending to put people to work if we ever suffered one of those shocks while technology is displacing jobs.
Okay. And we will find that out because this is a great technology, as we here at CIO Group know for sure. So let's talk a little bit about what Stephen was saying. You take a look at who's made money in the last 12 months. Obviously, semiconductors and equipment have done so. Memory chips have done extraordinarily well, right? And utilities, no surprise, right? Especially those that claim to be able to deliver power, whether or not they're actually going to be long-term beneficiaries, we'll find out, right? But you can see on the right-hand side, right, that there have been some deeply negatively impacted industries, one of which we happen to like, which is the private equity business, under the presumption that there's going to be a fundamental impact on private credit quality. And we are going to see some of that. There's no doubt that some of the loans that were made to certain software companies are going to come under stress. That is part of the narrative of making loans to private companies. But when you take a look at the impact that was universal across all of the businesses, from Blackstone to Blue Owl to Ares, you can see, even to Apollo, which claims to have relatively small exposures in this area of private credit, the fact is that people's confidence has been shaken in terms of what that ripple effect was. And Jamie Dimon added to that in his comments at his investor day, claiming that some people were making those kinds of loans from 2005 and 2006, all of which I think is somewhat self-serving. Our larger point here is that the data is going to give us plenty of clues as to where things are going, and we're going to be able to track that. The degree of renewal rates within software companies, the amount of money they're able to add in terms of larger customers, the retention rates that they have, and the substitution impacts of smaller startups that are going to be able to use AI to disrupt markets. All of that is sort of to come in front of us. We're going to have actual credit data associated with this. But from an investor's point of view, the need for discerning portfolio construction, for the selection of actually which companies, which sectors, which actual geographies one should be in, become far more important at a time like this, when there's significant policy uncertainty occurring at the same time as there is the impact from AI on software and its attendant downward stream impacts on financials. So you take a look on the right. And as Stephen mentioned, you've got deeply impacted areas like office REITs, IT consulting, right? Application software. Well, those are not all the same things. How many people occupy an office, has already been impacted deeply by COVID, right? We'll see to what degree, office demand falls. But application software is a very, very different thing, as Stephen's already talked about too, which is the number of people who are employed, right, actually is peaked. Right. But on the other hand, the impact of those software packages, right, is going to be enabled by AI itself. And the integration of AI requires labor to do so. So lots to come. We think that we're at a turning point in the economy where you're actually going to see employment rise slightly. Earnings are going to continue to rise, but impacts on sectors and geographies are going to continue to be significant, which is why our active asset allocation strategy, in our opinion, is the thing to focus on and really to accentuate in the next couple of years. Next slide. So where do you think we're? What do you think we're? Yeah, because I love this when you talk about the next bear market, right? I love that. So we are saying something here that you're kind of hinting at, Stephen. I want to say it out loud, which is you can't have a boom in chips forever. You just can't.
That's right. So look, I mean, the picture on the right is now the history, of nearly a 50% growth rate for a second year in computers-related investment. David, you sent me a picture, a projection that showed this actually growing to 2028, right? I'm not certain that it has to grow that rapidly until 2028. Again, the companies that are doing this investment, they're not doing this, out of charity for NVIDIA. Now, NVIDIA is sold out, and I think that can last through 2027. But you do have to think about that what happens when you have any piece of the economy, like hardware, that we're all buying because we want to run something. Well, what happens once we've got it? You stop investing at such a rapid rate. Tech has been powerful. It is essentially innovation. What NVIDIA does, and it's powering a $4.75 trillion market cap, is the design of chips that allow us to do new things like magic. So innovation's powerful. It's strongest in the U.S. equity market. And if you take a look at the picture at the left, even the gap that we have now between the reality of profits and current market cap isn't as extreme as it was in 99, 2000. We are going to stay invested in technology. We're going to take advantage of some of the dislocations that we see in software, but we're also going to make sure that we're not on really the wrong side by being overinvested in a hardware boom. So if you look at the next page,
Exactly.
you think about other things we need to do with portfolios, what is going to be the defense? In equities, it's healthcare. In fixed income, you have assets that have done extremely well. Look at long-term treasuries of 30% returns during the last two market collapses. We're talking about 2-year periods of time of a 30% return in a bond, right? That is something that you need in that period when you do go bust. Gold has done pretty well too. Problem is it's done 70% over the last year. It's at a record high inflation adjusted price.
And we're not telling you there's going to be a bust tomorrow, but we are contextually saying that you've had now a period of time through 2025 when you've seen, returns in excess of 14% a year for a decade. When your normal rate of return in the S&P, which is also very attractive, is somewhere near to 10%, right? And so the vulnerability of the market at this time, given all of these factors, is high. And the absence of preparation, right? The absence of diversification is a theme that we see in family offices and ultra high net worth portfolios everywhere. We also see a great reliance on active management, this idea that somehow people can sort of figure out where it is that these individual companies are going to be winners and losers. And that certainly has been a losing game in the last 12 months. It is far more important, in our opinion, to have the right sectors, the right asset allocation, the right mix in order to have a resilient portfolio and to actually have the opportunity to produce alpha in terms of investing. Next slide. So we want that diversification away from U.S. centered risks that we've outlined in detail to be a centerpiece of what you do in your portfolios, what we advise, what we implement. You take a look at the outperformance of international last year, and it was granted that 2025 was the first year in a long time that international outperformed. But many people assumed that was going to be a one-year phenomenon, not CIO Group. We talked about the fact that there was likely to be sustained international outperformance. And Stephen, we've seen it already in the first 2 months of this year, right? I think we're talking about what? 7% outperformance so far?
We're talking about right as of today, non-US equities in dollars have had 8% more return than US. And again, with our weighting, it's bottom up. We're trying to find the best industry sectors wherever they are inside the US equity market. It's going to give us a full weighting, but we would still have in non-US equities for a balanced portfolio, if you're thinking about something like a 60-40 portfolio, 21% non-US weighting. And thus far, that's allowing us to have about twice the S&P return in a broad portfolio just this year. If you look at the next page, we just go through this asset allocation in brief. Some of the things that we're doing without shedding software after a big hit. We've taken advantage of what's going on in energy. Energy infrastructure through master limited partnerships can offer us an 8% or potentially higher yield. And depending on how you implement, favorable tax benefits. So that's an asset where we don't expect the boom and bust in the oil price to be driving that much of the variation. The fact is that if you want to run AI, you're going to need utility fuels, right? So pipelines and LNG exports, that could be subject to trade, but that's a part of the business. And that's getting an additional part of our portfolio in the form of yield, not just the expectation of appreciation. But we will talk about this weekend's bulletin. The fact is that we continue to be bullish on profits. We expect double-digit profit gains in 2026. NVIDIA is sure doing it. We'll think about what's happening on the other side of that in the coming couple of years, but we can still stay invested with plenty of diversification because the things that have boomed the most are not offering the highest returns now in markets.
That's great. Well, thank you very much, Stephen. Thank you very much for listening. I know it's been a long program today. But it is important to think about, right, as we started out with these three large impacts, right, associated with, some of the political issues in Iran, some of the trade issues associated with the tremendous amount of policy uncertainty that's been extended by the Trump administration's decision to carry on with a different tariff policy, ignoring the intentions of the Supreme Court, and of course, with the huge potential impact of AI that is coming in front of us, both for increased profitability and potential labor impacts. All of this is on our mind at CIO Group, and we'll keep it on your mind by continuing to inform you about our views on it every single week. Stay tuned for The Point and our written piece this weekend, which is excellent, Stephen. Thank you. And we will, of course, be back next Thursday at 11:30 with more incredibly exciting and potentially, actually, would be nice if it was somewhat less exciting news. Thank you so much for joining. Bye-bye.
Thank you.